Hi everyone, welcome back to the US CPA classes for financial accounting and reporting. In this particular video, we'll be discussing in detail about stock-based compensation. Yes, in that we'll be understanding stock compensation valuation, fair value methods, and the modification in stock-based compensation and how to account for the same. So let's dive into it to understand more in detail.
Stock-based compensation. So what is stock-based compensation? Any idea?
Yes, sir. So basically, when the company pays off to its employees in the form of stocks, which can be termed as given different names like restricted stock units, ESOPs, employee purchase plans, these all are called stock compensation or share-based payments.
So what exactly employer pay to employee in in stock-based compensation?
Sir, it's own stocks, it's equity shares, which may be which might have different conditions attached to it, like vest over a certain period of time after serving for certain number of years or months. So basically, they pay their equity shares to the employees.
Anything else they pay? How much they pay, when they pay, why they pay? Any idea?
So ideally, mota, it's like a retention policy thing. If they're giving like, stock compensation options to their employees, so it's so that in order to give them a sense of belonging towards a company, in order to make them a loyal like customer, like employee of the company. So in that sense, some companies tend to give some ESOPs. Very basic understanding.
Anyone else have any idea? Rahul, Ananya, Santrupti. Any idea what is ESOP is? Are you guys here? We are still on break.
सर कुछ मतलब आइडिया नहीं है, थोड़ा मतलब जैसे आयुष ने कहा तो मतलब वही थॉट है मतलब कि the company is paying to their retired employees in terms of stock and all.
Not to retired employee, to the existing employee basically.
Yes. Yes.
So ESOP is generally like nowadays, if you see, like how many of you watch Shark Tank or something? Have you guys watched Shark Tank season 2?
सर बैकग्राउंड में
Yes,
भाई
sir.
बैठ के वही देख रही है।
कौन?
मुझे हॉल से आवाज आ रही है, मेरी भाई वही बैठ के देख रही है सीजन 2 का एपिसोड।
So when you go back, she'll ask, "Welcome to Shark Tank." So your pitch was nice, but tell me the numbers now. Huh?
I'm out.
I'm out. It's not my area of expertise. Yeah, so like ESOPs are basically given to the employees, especially to the leadership level or high performing employee, yes, to majorly to retain them, to make them feel part of the company, to make them feel like for what they're working hard, they will get the appropriate reward for their hard work, right? But this is given to the existing employee, and there are two things, like first is grant of ESOPs or grant of stock-based compensation, and then there is a vesting period, and then there is an exercise of the stock-based compensation. So grant date is basically that date when stock-based compensation is being issued to any employee or to the employees. And vesting period is basically the period for which they need to work for the company to gain those benefits. And after the vesting period comes exercise date. So exercise date is the date when employee get an opportunity to you can say purchase those ESOP or to avail those ESOP. right? But in between, there are certain forfeitures also, like certain employee left in between. So their shares get forfeited, right? And the ESOP can be of your own company share, can be of your parent company share, can be of your subsidiary company share, or can be in cash. Have you heard about the term called phantom shares? Santrupti, Ayush, Gurmeha. Now, so phantom shares means the value of that share on the date of exercise, and the company will pay you cash rather than giving you actual share. For example, let's say Ananya has joined a company called, let's say, JLL. And JLL has given Ananya 1000 shares if she continued to work for 3 years. So after 3 years, Ananya can avail the benefit of those 1000 shares of JLL, and she can encash them. So she will not get the actual share, but she will get the equivalent cash value. Right? So now Ananya has worked with JLL. So on the date Ananya has received this offer is called what date?
Exercise date.
Now, I just said this.
Exercise actual में जब वो exercise करेगी मतलब basically option को लेगी.
Grant date.
Grant date, sorry.
Right. So when offer is given to Ananya is the grant date. And what is the vesting period?
The period she has to like wait until she can exercise the option.
Which is 3 years. Right? From the date of joining to 3 years, she need to work with the JLL. Right? After 3 years, there is an option. Right? There's an option that Ananya can purchase or Ananya can exercise that stock options. Right? So on the exercise date, there might be two things possible. One is at specific price the company will offer to Ananya, or it will be completely free of cost available to the Ananya. Right? When it is free of cost available to the Ananya, then whatever the market value on that date would be considered as the value of ESOP or share-based compensation received by the Ananya. Or if Ananya need to pay anything to avail that option, so that means it's an option to purchase. For example, those 1000 share have market value of $20 each. How much is market value? $20 each. Multiply by 1000, it is $20,000, right? Whereas Ananya need to pay, let's assume $25 each to avail that option. So will Ananya purchase that option? The answer is no.
No.
Right? Because the market value is less than the option price. Yes, agree with me?
Yes, sir.
Yes, sir.
And let's assume Ananya need to pay $10 per share, whereas market value is 20. So how much is the additional worth share Ananya is getting?
$10.
$10,000. 10 multiplied by 1000.
Yes.
Right? So $10,000 would be Ananya's compensation, stock-based compensation. Make sense, everyone?
Right, sir.
So stock-based compensation can be in actual shares or can be in phantom shares, which is being converted into cash. Make sense?
Yes, sir.
So ideal scenario में the first option which you quoted, वो तो नहीं होता होगा ना. So why would a company give an option above the market price of the share?
No, like when you have grant, at the time of grant, you agreed that at the time of exercise you need to pay $25 to me. And at that point of time, they were expecting that share price will go to the $50. But when after 3 years, if the actual situation is that the market value is $20, so that can be possible. You know,
So
at the
is
time
there
of grant, it is being based on future projections.
so इसपे कुछ agreements ऐसे होते हैं कि in case the price gets lower than that,
Yeah,
so
cap and
they'll get an
floor.
option on
Yeah.
that price.
Yes, yes. Seal and floor generally is part of SHA, shareholder
Okay.
agreement. Yeah. Yeah. Are you sure saying something?
No, sir. Clearer.
So now look at the theory. Stock compensation is a way corporation use stock or stock option to reward the employee in lieu of cash. So instead of cash, the company provide shares to their employee, right? So again, here are like various category of companies. So it can be a startup, it can be a mid-sized company, or it can be a very stable company like JCB, Goodyear, Fidelity, Ericsson, right? Or it may be possible like startup like 𝐂𝐨𝐬𝐿, or it may be possible like some mid-sized company, right? So here, like every company do have different category of arrangement. So big company, generally a big giant company like Fidelity, Ericsson, Goodyear, JCB, or maybe General Motors, or maybe Amazon, they give phantom shares to the employee. What is phantom share? That means they give you, you can say they grant you the share, but when it actually is come to the exercise date, they give you equivalent value of cash, not the actual share. That means, for example, if you are employee of Amazon, so at the time of joining, they might have given you, let's assume 1,000 shares, which you can encash after 3 years, whatever is the value of the share after 3 years. Why do employee accept this? Like, for example, Ayush, if I ask you to join 𝐂𝐶 and I'll give you 1% equity share each year you work with me.
Yeah.
As an ESOP, let's assume, right? So why would you join 𝐂𝐶 for this?
Sir, I'll be joining as an employee in the company, but otherwise also I'm getting this benefit that I'll be getting the shares, that 1% equity every year or whatever, however it works. So it will be beneficial for me because I can, after the vesting period is over, obviously I can sell it off and that money.
No, yeah, I'll tell you, like more benefit is that, for example, like startups company, which is being like growing at a massive scale nowadays in a world, not only in India, but to the different part of the world.
Right.
So today, maybe like the value of a startup company share may be $100.
Yeah.
But as you grow in 3 year to 5 year time, it may go up to 100x.
Yes.
Right? That $100 may value to you $10,000 a share. And if you get 1,000 share, then multiply by 10,000, you be a millionaire.
Yes.
So you can earn more than the salary from the shares.
Correct. And sir, in my company as well, after this COVID period, so there was a similar kind of an option, which was, it was not an option. Actually, our company, that this Australian distributor, gave shares to every employee. Okay, but its vesting period was just 1 year, that they will mandatorily not give credit shares to their demat account or GDR accounts, and they will directly pay cash to them in at the market.
Say that again. Sorry, help me understand.
Basically, क्या था कि there were salary cuts during the COVID period. Okay. So just as a goodwill gesture, when the company was in a good position, so a holding company issued shares to every employee, irrespective of the position, of like, suppose say 1,50,000 shares in INR, उस time पे grant date पे, correct?
the Toby employee is staying there for 1 year, they will get cash for that at the market value which is present on that date. Okay. So it is okay. Actually, it was when at the grand date it was 15-14 rupee share. Now it is 20 Australian dollar. So वही 6 रुपए का फायदा तो रहता ही है मतलब and जितना ज्यादा will the company is growing, it will eventually help अगर किसी के पास shares vested है, rather than if they were only paying incentives in cash, that will be always a fixed amount that will never grow
Yes.
to the market. So
Very
that's a plus when we get the stock options from a company.
Yes, that's how like in the startups, like we hire leadership, like startup companies generally hire the leadership position by providing ESOP pool. And each startup must have like 5 to 15% of ESOP pool if they really wants to grow big.
Yes.
And they really wants a good people to join them. So we also have like almost 15% pool for the ESOP.
Okay. Okay.
Right. So now coming to the theory. So stock compensation is a way that corporation use the stock or stock option to reward their employee in lieu of cash. So it can be used as a tool for the payment or compensate to the non-employee as well. So it's not only for employee, it can be for the non-employee also. Stock compensation, you can even pay to the vendors also. For example, today, someone has given you space to work, right? And he is not charging you anything, right? To them, you can also give like 1%, 2%, or 3% of your share that in future, if your company is earning, then you will be, then he or she will be getting the benefit. Just give me a second. Sorry. So let me come back. Yeah. So like ESOP, the stock compensation, it can be the pool to the employee as well as to the vendor. So to the vendor also you can give the stock compensation. Or for example, if let's assume any of your friend has given you like their office space for you to work, right? And he's not charging any rent or any facilities benefit to you, right? In a way, he or she is your vendor, right? And you can give him like 1%, 2% as a stock compensation. As your company grow, he or she will also get the benefit of that growth, right? So that's also happened like in this startup world. Right. In addition to that, like in a startup, like I'm also like a mentor for some startup. So we also charge 2 to 3% or 2 to 5% as a mentorship fees. We don't charge money because startups generally do not have money to pay to the like senior leaders of the industry, right? Because their charges would be ultra premium, but they need the guidance, they need the support, they need their contact, they need their references, right? For that, generally startup mentor, they charge in the range of 2 to 5% of the shares. So that also be stock-based compensation as a mentorship fees. Are you getting my point?
Yes, sir.
So stock-based compensation, it can be for employee, like whatever you have learned or whatever you have heard so far is for the employee side of it. That is called stock-based compensation or ESOP. But other than that also, like you can make the payment through the stock compensation. Like I said, mentorship fees, or maybe any of your friend has provided you infrastructure support. To them also you can give some stock-based compensation. Make sense?
Yes, sir.
Yes. Okay. So ESOP, employee stock option plan or employee stock ownership plan. So commonly, like, these terms are interchangeably used in US. An employee stock ownership plan is an employee benefit plan that give worker ownership interest in the company. Liability, you need to recognize when some award of share-based compensation necessitate the recognition of liability by issuing the entity, because the employee can require the entity to settle the award by transferring asset for the employee rather than issuing equity instrument, for example, phantom share. So here what they are saying, the arrangement is ESOP, but at the end you will be paying any asset or cash to the company, not actually equity share. So in that case of scenario, you should not recognize that as additional paid in capital. Rather, you should recognize that amount payable as accrued liability. For example, let's assume like Ayush has given me a piece of land, right, to do the business. And to do the business, I need to build an infrastructure on it, right? Let's assume I have invested $50,000 and build a floor on it, right? And we agree that after 5 years, I'll give this building back to the Ayush. Are you getting my point?
Yes, sir.
So that means that whatever $50,000 I'm investing will go to the Ayush after five years, right? Same way, there may be a possibility there are certain share-based compensation for which I'm paying you asset or cash, but not the actually equity share. So for example, let's see in this you can say arrangement, Ayush would be working with me for 5 years, and in lieu of that, I have given, let's assume, 2% of equity share or the value of the infrastructure which I have built. And Ayush has opted the value of infrastructure which we have built, right? In that case, I'm giving Ayush the value of infrastructure instead of actual equity share. Or like we have discussed another example of phantom share, in which whatever is the market value of the share, after 5 years, I'll pay him cash. So in that case of scenario, it is my liability. It's not my equity. Because at the end, I need to pay cash or I need to pay in asset to the Ayush. Make sense?
Yes, sir.
So I need to book liability year over year in a systematic manner. In this case, the entity need to recognize the liability in place of additional paid in capital. Next is non-employee share-based payment, which we have discussed, like mentorship fees, service provider, supplier, like for example, like let's assume Rahul and Ananya wants to build any company. Let's assume they wants to build similar to Ola. Let's assume they want to build similar to Ola, and they have involved 𝐒𝐿 and Ayush to build that platform. Let's assume like 𝐒𝐿 is front-end developer and Ayush is back-end developer, and they involve these two people to develop a platform similar to Ola, right? But they do not have money to pay them because it's very expensive and they are expensive resources, right? In that case of scenario, what they will do, will give you 40% equity share in our company if you build this application and successfully run this application for the company. Let's assume Rahul and Ananya is good in sales, marketing, and operation, and 𝐒𝐿 and Ayush is good in technology development. So they have partnered with the Ayush and 𝐒𝐿 to build the technology, and in compensation of that, they are ready to give them 40% equity share. Right? In that case of scenario, Ayush and 𝐒𝐿 is a service provider or a supplier. Now they're getting equity in returns of the time or energy they are investing. Make sense?
Yes, sir.
So when company issues share-based payment in lieu of goods and services to non-employee, then it is called non-employee share-based payment. Sounds good? Two type of share-based payment, employee and non-employee. Yes. Now coming to the valuation side. How do you value the stock? Normally you use fair value, right? But if fair value is not available, then you are using intrinsic value. So what is fair value? Any idea what is fair value?
Fair value will be the market share, market price of the share on the vesting date, which we will be using.
On the grant.
On the grant date. On the grant date, we will be using it. And intrinsic value is the, it's calculated basis the company's net worth. What will be the price of the share according to the assets and the liabilities after they are net off, what should be the intrinsic value of the company. After paying off all the liabilities, what will company be left? Basis that the intrinsic value is calculated, if I am correct. Well, sir, that can be the difference.
How about others like Gurmeher, Rahul, Prashant?
तो fair value तो पता है, intrinsic value जो है वो पहली
What
बार
is fair
word
value?
सुन रहा हूँ. So fair value is basically the prevailing value in the market. So what is the actual, like the value they are getting in the market basically? What is the fair value? So you rectify your value basis that you revalue something on the basis of those prevailing market rates. और intrinsic तो नहीं मुझे idea मतलब.
And that's a new terminology.
Basically, sir, intrinsic value में future का कुछ नहीं देखते.
Yes.
जो current company के पास है assets, उसके basis पे भी calculate कि what should be the share price.
Yes, yes, yeah. Prashant, Ananya, you have any idea? Rahul? No idea. Okay, so don't worry. In your FAR exam, it will be given to you what is the fair value, and if no fair value is given, then intrinsic value might be given to you. So you do not probably need to calculate the fair value or intrinsic value, but just for your understanding purpose, the fair value will be applied to the share-based payment plan most of the time, except the equity instrument. In that you go with the intrinsic value. But share-based payment are treated as contribution plan and expenses recognized over the vesting period. But first, let's understand fair value. Like you rightly said, Ayush and Gurmeher, both of you, like the fair value is normally like the expected market value, which may be like the amount you can recover or realize if you sell those assets in the market, right? Intrinsic value is more of like their book value, how much is the total assets minus how much is the total liability. Whatever is the balance is generally called as intrinsic value of the share, and divided by number of share, then you get per share intrinsic value. But fair value measurement of share-based payment is to be considered on grant date, right? And same is the intrinsic value, that also on the grant date you identify. And whatever is the value and whatever is the number of year, which is like vesting period, you need to amortize the cost over the vesting period. So what is grant date? I think that also we have discussed. Grant date is the date of agreement between the employer and employee to give the option to the employee to own the shares. And vesting period is the period that exists between the time when employee issue the ESOP till the time such employee gain the access or exercise the right that attached to those ESOP, right? Now coming to the methods to calculate the fair value. So first we understand the method, options, valuation methods, fair value method and intrinsic value method, and how to do the accounting under those. But now let's understand more in detail what is fair value method. So how do you calculate the fair value, right? So for calculation of fair value, there are two methods given. One is observable method and second is other than observable method. So observable method is basically when you need, for example, you have started a new airline and you're planning to start a flight from San Francisco to New York. Then how do you calculate the value of the ticket of your airline should be? Are you getting my question? I'm saying, let's assume you have opened up a new airline. And you have started the flight from San Francisco to New York. What price you will charge and how you get to that price?
I guess there would be like behind pricing, there are different factors. First would be your cost involved, right? And then maybe you'll add the expected margin to that. Since you are new in the industry, you'll see what are the big players charging for that like flight, right? And in order to compete, or maybe because you're a new player, then you have to like price your commodity at such in such a way that you are able to survive the competition. So but other factors will come into picture. We'll see the cost, you'll see expected revenue, margins, and then the prices which are being charged by the other players in the industry.
Yeah, for example, San Francisco to New York, there are flights called American Airlines. There's a flight called Delta. There's a flight called Frontier. Let's assume Delta charge $120. American Airlines, they charge $115 and Frontier charge $100 per passenger per flight. But your cost is coming $150. So what will you do? Can you charge $170 or $180?
I don't think so.
Because no one will come to you, right?
Yeah.
So let's assume your cost is coming $80. So what all factor you'll be considering to come up to the sales price of your flight per passenger?
So it's like the other player is charging 120 for the flight.
Yeah,
And our
100,
cost is
115 and 120. Let's assume these are the three
yeah.
prices.
So our cost is 80. So maybe we'll add $15 or $20 to that, and we'll charge $100 in order to compete them. Because you're a new player, you might get some benefits, and you keep your pricing less than the other players. So maybe
Anyone
we will charge
else?
$100.
Anyone else would like to attempt this question?
सर हमारी कॉस्टिंग पूरी हो गई है ना 80 में, मतलब
हाँ, let's assume 80 is your cost.
फिर वो तो फिर what I feel is कि what is the company's overall strategy of entering the market, that will be considered in setting the price, ticket price per pax. So that should be it मेरे हिसाब से तो. और factors, there can be other factors as well, but mainly strategy रहेगी कि if you want to enter into a new market and initially we can offer the tickets at a lower price, then we can attract more customers, and then eventually when this airlines is successful, we can eventually increase our margins to match those margins. And
basically growth target, margin target, revenue target, these all would also be considered.
Okay, go back to the earlier days in 2010 when your good friend Vijay Mallya was here, right? So there was like airline called Indigo, Jet, Air India, right? And they open up Kingfisher Airline, right? Let's assume Mumbai to Delhi flight, Air India was charging, let's say, 4,000 rupees. Indigo or like SpiceJet, they're charging, let's assume, 3,000, and Jet was charging, let's assume 4,500. And what was the Kingfisher charges? Any idea?
नहीं सर, वो ट्रैवल नहीं करा उस एयरलाइन ना.
Okay.
Sir, can you repeat the question?
Interesting question. Like your old friend Vijay Mallya, he was having a airline called Kingfisher, right?
Yes, sir.
So yeah, so suppose go back to the era of 2010 when there was like jet airlines, like who was charging, let's say, the Mumbai to Delhi flight for 5,000 rupees, right? Air India, let's assume they are charging 4,000 rupees, right? And there was Indigo and SpiceJet, let's assume they are charging 3,000 or 3,500, right? And the costing for each airline, basic travel cost, you can say variable cost is, let's assume, 2,000 rupees. And now you are advisor to Mr. Vijay Mallya. What amount you should advise, you will be advising, and how you are calculating that amount, that this much fare we should charge for Kingfisher Airline.
See, sir, if you are in growth phase or in early phase, you will either work on no profit, no loss basis, or you may take some loss to get the market share. And then maybe like my variable cost is around, let's say, 2,500. Maybe I will charge additionally. So, and I don't know what will be my fixed cost. Again,
No,
I will try
if let's assume like all costs is 2,000 rupees, variable and fixed.
At least I will charge 2,000 rupees. Otherwise, I will be in loss. I will be burning my cash. And I will
why we all are so conservative? Can you see like what all benefits that Kingfisher Airlines was providing?
Yes, sir. Actually, they were providing some food, some drinks. It was not a low cost air. I mean, it was not. It was a kind of a premium services they were giving.
Yes, that's what I'm coming to.
At lower cost, means
not at lower cost, not at all. Kingfisher was never be a budgeted flight, right? They were always be in a premium category, right? What all factor we consider when we reach to the pricing is what all facilities I am providing and what all facilities others are providing, right? Those things also we need to give the consideration.
But all those who are providing premium services or provided premium services in airline industry, they went bankrupt actually.
That's a different story. That's a different story. But like how do you reach to the price point? Basically, it's called observable market price, in which you are observing how like other players in the market is charging. That's an example I was sharing through the different airlines. But what I wanted to make you understand is about like the concept of observable market price, so that you can correlate this theory with the practical experiences you have. Right. So observable market. Yes,
I have a question, sir. Observable market price is driven by demand and supply, right?
Yes. Yes, absolutely true. Absolutely true.
Yeah.
So here, for example, let's assume in the Aero City here in Gurgaon, right? There are so many hotels like JW Marriott is there, Oberoi's is there, Radisson is there, many other big hotels are there. Like, and you might have seen like nowadays, like on Go, Make My Trip, Yatra, you'll see how those 5-star hotels are reaching out to their price point for their room rent. They're also using observable market price. Are you getting like from where I'm coming?
Yes, sir. Again, it is like depend on the season and then the like.
Yes, there are certain
So
factors.
yes.
There are certain parameters that you as a company need to keep an eye to reach to your price point. It's not always your cost plus mark. That's what I mean to say.
Yes.
Right? So observable market price play a significant role nowadays in a market to reach to your fair value. Right? So in the observable market price, you will see your costing, you will see your competitor price, you will see the facilities you are providing, you will see the facilities your competitions is providing, you will see the peak period or non-peak period, right? So all those permutation and combination will help you reaching to certain price point. That is called observable market price. Make sense?
Yes, sir.
Where you are observing the market, different parameter of the market to reaching at certain price point. That is called observable market price. Where observable market price of a share with the same or similar terms and condition that meet at least the following conditions. First is exercise price of the option, expected term of the option, current price of the underlying share, expected volatility of the price, expected dividend, and risk-free interest rate. So what all things you need to consider to calculate the observable market price of the share, right? As of now, two examples which we have discussed is airline and hotel. Now coming to the shares. How do you calculate the price of your share based on observable market price? Let's assume you are Tata Motors. So you'll be looking at the similar kind of companies. Let's assume General Motors. Let's assume Skoda, right? Let's assume Maruti. Let's assume Hyundai, right? How their share prices are moving and how this automotive industry is moving. All those factors you'll be considering to calculate the market price of your company share. If you are listed, then it is directly from the stock exchange. If you are not listed, then you will need to look at observable market price. Observable market price of the similar industries companies share, right? Which is being of similar terms and condition. That means, for example, if you are giving equity share without voting right. Have you heard about this term? Equity share with rights or without right. Have you heard this term?
Yes, sir.
So they both have different value, right? Which one have more value, with right or without right?
With right.
Right? Because you are getting an authority to participate in the decision making of the shareholders, right? Without right, you'll be getting less value. Same way, let's assume you have 10% convertible debentures of X limited company. So the term is 5 years. So what is the value of those debentures you need to keep? So we'll be comparing the 10% debenture for the 5 year in similar kind of industry with the similar term. And what is the price of that? You consider that as a base price. And then you will do certain plus and minus adjustment, right? So what all things you need to consider? First is exercise price. Second is term. Third is current price, right? Fourth is volatility in the market. And fifth is expected dividend. Like this 10% debenture, if you are giving semi-annually interest or you are paying accumulated interest, that also you need to consider. And then what is the risk-free interest rate? So those all adjustment you need to make to calculate the price or calculate the fair value of the respected share. Make sense?
Yes, sir.
So there are three methods to calculate the fair value. If your company's share are listed, then it is directly from the stock market. If it is not listed, then you are using either observable price or the other valuation method. So observable price we have discussed. Now jump into the applicable valuation technique. Applicable valuation technique is used when observable price are not available or your stocks are not listed. So valuation technique should be one of them. First, that applied in a manner consistent with the fair value measurement objective. So whatever the technique you are applying, it should be consistent year over year. It should not be you are changing year over year. Second important thing is based on established principle of the financial economic theory. Third is reflect all the substantive characteristics of the instrument. There are certain standard method given, which is binomial method and Black-Scholes method, right? So this is given to you in your exam. So you're not supposed to do the valuation. That is comes in the actuarial exam, not in the CPA exam for sure, right? But you should be having an idea. The sequence of, you can say, terminology or sequence of fair value you need to consider. If your company stock are being listed, then you need to take from the stock exchange. If not listed, then first preference is to observable market price. If observable market price is not available, then valuation technique. Valuation technique can be Black-Scholes model or can be binomial model or can be discounted cash flow model, right? But this all will be given to you in exam. For a CPA purpose, you are not going to do any valuation, right? That's not part of your course and curriculum. That's part in actuarial testing. Make sense?
Yes, sir.
Okay, so modification in stock compensation or share based. Modification is considered when there is a change. So change in award fair value, change in vesting period or condition, or change in classification. When there is change in the period or value or classification, then you need to consider the change accordingly. So which is repricing of share, change in service condition, performance condition, market condition, or change in terms into reclassification and adding involuntary termination clause. So then you need to consider the modification and revalue them accordingly. Entity must disclose if modification result into change in compensation expense. So if there is any change in the share price, or if there is a change in the classification, or if there is change in any terms and condition of the compensation plan, then if it is impacting to your expense, then you need to disclose it separately. Exception to the general rule, forfeiture impact on the recognition of the share-based award. Entity are permitted to make an accounting policy election to consider the impact of forfeiture in the period of forfeiture or opt a modified retrospective approach and adjust the cumulative effect of forfeiture to the opening retained earnings. So what is forfeiture? For example, let's assume Ananya has joined JLL, right? At the time of joining, Ananya has received ESOP. But for that, Ananya need to work with JLL for 5 years. But Ananya, after 2.5 years, got a good job, let's assume with Microsoft, and she left JLL. So at that time, her share will get forfeit because she has not served 5 years, right? So this forfeiture, whether you need to account for in the year when Ananya has left, or do you want to consider the impact retrospectively? You can choose either, but that can be considered as accounting policy, right? And accordingly, you need to consider the impact on financial statement. But that accounting policy, you need to follow consistently. It should not be like in 1 year, you're saying the forfeiture impact I'll take in current year, or in another year, you will start saying I need to take it retrospective. That will not allow. So you need to follow any accounting policy consistently. Right? Let's do this 2 quick question. Guys, ready?
Yes, sir.
Yes,
Okay.
sir.
In compensatory stock option plan for which the grant, vesting and exercise date are all different, the additional paid in capital stock option account should be reduced at which date? Are you getting the question? The question is saying compensatory stock option plan is given, right? And that, let's assume grant date is 1st January 2023. Vesting date, let's assume is 1st January 2024, and exercise date is, let's assume, 1st January 2025. So in which date the stock option should be reduced?
Sir, exercise date only, because that's the date the company is actually
converting the ESOP into actual stock. Right? Everyone agree? Rahul, Ananya, Prashant? Exercise date is the date when stock option is being converted into actual equity share and given to the employee. Hence, on that date, additional paid capital will convert into equity. Make sense?
Yes, sir.
Okay, last question of the day. Shareholder of Mini Cooper approve a stock option plan that grant the company top 3 executive option to purchase a maximum of 1,000 share each of minis at $2 per common share for $19 per share. The option were granted on January 1 and the fair value of the stock was 20 per share. M determined that the fair value of the compensation is $300,000 and vesting period in 3 years is 3 years. What amount of compensation expense from the option should M record in the year of option was granted?
So $1 lakh.
Why?
So vesting periods divide कर देंगे उसको.
Simple, very simple. $300,000 divided by 3 years, 100,000. Make sense, everyone?
Yes, sir.
Okay, so I think we are done for the day. Any doubt?
No, sir. Sir, ये chapter हो गया ना. Next, उसमें अब
Next we'll start inventory. Tomorrow we'll start inventory.
Okay.
So I'll send you this notes right away. Like I have meeting from 1 to 2, but around 2:15, 2:30 you can expect these notes.
Okay, sir.
Cool. Enjoy rest of your day. Let's start inventory tomorrow.
Okay, sir. Bye.
Thank you.
Bye. Have a good day.